Hi again. We're continuing on some videos on some of the little things that help us make trading decisions. If you like this kind of video, please make sure to subscribe, like, comment, and share. We'd really appreciate your feedback. Now let's get started on the topic today. It's going to be the fallout of Archegos capital. So let's get started. Recently in the news, as on Friday, this past Friday actually, there has been a lot of news about a fallout of a hedge fund called Archegos Capital, a hedge fund or family office. Here's some of the headlines here that we can look at. For example, some prime brokers that helped finance Archegos trades are trying to limit losses. There's talks about these stocks being offered in what's called block trades, or trades that are large trades that are put together and distributed to other clients who are willing to buy. And already over the weekend, there's some commentary over the stocks that Archegos Capital actually held, got called on margin, and led to a very huge liquidation. So we'll take a look at which stocks they are, how it's affected the markets a little bit, and maybe some of our opinions on some of the stocks that have gotten beaten up. So let's take a look at some of the stocks here. It's easier to look at Nomura Holdings, who was a very large prime broker to Archegos, held a lot of their stocks. They reported that they're going to lose, as of yesterday, upwards to $2 billion. The number today may have actually increased, as I think a lot of these stocks have actually continued to fall in the US hours. So some of the stocks that we can look at here, the major stocks that Archegos had is ViacomCBS, GSX, Tekadu Inc., VipShop Holdings, Discovery Inc., Baidu, and this IQE, among a couple other ones. And then there's, of course, there's Tencent Music Entertainment Group. So all these stocks, including a couple more, took quite a beating. And these are the stocks that Archegos apparently has held. So let's take a look at what's caused this margin call to happen in the first place. Obviously these Archegos was highly levered in these shares. So they were probably taking, it seems the news is that they had $80 billion in positions being funded by about $15 billion of equity. So it looks like they were about, looks like they were about 5 to 6 times levered, which is actually quite high for some of these names. But given how low interest rates are and the lack of recent volatility in the equity markets, I can see how these banks may have actually pushed themselves to lend a lot more on thinner capital than what's usual. So let's look at some causes of the sell-off. So as of at least a week ago, as of March 24th, so that's about a Wednesday, basically Chinese tech stocks have started to already start falling because the SEC has begun a rollout of a law at delisting Chinese listed companies due to their reporting, what I'll call their perceived reporting non-compliance that may occur. At the same time, if you look at one of their major holdings, which is ViacomCBS, they actually offered a very large chunk of shares in a secondary offering, both exposure through mandatory convertible stock and also common stock. So you have some companies on one side issuing a lot of shares against their, what I'll call possibly their inflated valuations, and you see Chinese tech stocks starting to go down because they are facing possible delisting in the US. So that's kind of what has created the very fast snowball of the price action, which then triggered these margin calls on what looks like Friday. Okay, let's look a little bit at Archegos history. So Archegos is a family office / hedge fund of a rather infamous portfolio manager, Bill Hwang. Archegos was a spin out of Tiger Asia, and Tiger Asia, as in 2014, were actually found committing some wrongdoing that is related to insider trading. from back in 2008 and 2009. So it definitely the reputation of this family office is definitely not pristine. So there could be a lot of still a certain level of distrust between the banks and this particular client. So it's some interesting backdrop to the losses here. So as you can tell here, when you look at this, it's quite a damning comment that the Market Misconduct Tribunal found that Mr. Hwang's conduct constituted serious misconduct and little trust can be placed in Bill Hwang's integrity. So quite a tough conclusion there to go with. Okay, so we'll take a look at some of the stocks, the price action of a couple of the stocks that we pointed out. We're not going to go over the Chinese listed stocks because there is a real fundamental driver possibly with the delisting that there's a lot of other noise, which we kind of want to, we don't know how to actually underwrite or price this risk. So we'll look at the two other US-based stocks, very common stocks in Viacom and also in Discovery A. So let's take a look at these stocks. So we can tell that since March 23rd, even after the placement of block secondary shares, it was trading at a high of, even it was higher even before, but we could see it was trading around 90, a little bit above 90 US dollars. And then you could tell afterwards, you could tell this increased volume here. I think this is probably have to do with maybe the stock offering or thereabouts. The stock has continued to fall and make its declines. Finally, until we find that on Friday, there was some block and forced selling here, which actually created a very large decline all the way from what we'll call $65 to $40, which is a huge loss. For a company like CBS is just a broadcaster. It's a very much a cash cow company. They have plenty of cash. I think they just signed an NFL deal, so they have plenty of cash. There's nothing to worry about here. But you could tell the amount of liquidations that have actually occurred is quite a lot. It was able to find a bottom here with quite a bit of volume. So this is an interesting stock. It's now trading probably on an 11 or 12 PE. So given where interest rates are, this could be quite an interesting pickup here. So this is one stock that we've looked at. It looks like it may take a couple of more days for the volume to clear, but definitely something very interesting where, for a short-term trade, one man's trash, which has been forced to be taken out, could become another man's treasure. So quite interesting here on this price action. So we'll look at Discovery A. So let's take a look at this stock. So again, almost like this CBS Viacom stock, we actually see a very, very similar price action here. We see some highs on March 23rd. We see some increased volume here as the stock is going down. We see it just drift down and then finally bang. You see this effect of this liquidation here, along with very high volumes. Again, we see still the residual fallout. So we expect this kind of fallout and the stock to really stabilize probably in the next 1 or 2 days. Again, these stocks do offer quite good. I think they offer a good entry point, at least for quick trades. And that they've really been sold for no reason other than banks having to liquidate and to be able to recover what is left of their loans. So I think this is quite interesting to keep an eye on these two stocks to acquire. These kind of sensational hedge fund blowups don't occur very often. So we've moved away from crypto today to talk a little bit more about the stock markets. Okay. So we can take a look at Goldman a little bit. Just a little side story here is, Goldman Sachs has quite a good history of liquidating hedge funds. One of the first ones I remember was one in Japan where there was a hedge fund called Fuku, which, back in the day lost almost its entire capital in just a few days, very reminiscent of this Archegos capital, when basically they had a very large position, being basically I think that they were long. They were long. Which one was it? They were long NTT, which is the parent company of NTT Docomo, which was short basically on a sum of the parts arbitrage play. So when this ratio went up, their short position in Docomo was actually blowing up against their long position in NTT. And it only really took about 15 days or 2 weeks. And then it really exacerbated for the losses up here. For them to be blown up. And at the time, it was even rumored that Goldman actually leaked some information to other hedge funds, and other traders were actually trading against their imminent blow up. So quite interesting there that Goldman was the main prime broker for Eifuku, and the position pretty much blew up in their face. Now, given you take it to be about a month later, you can see it actually, the spread retract as this one event, the market actually cleared, and then you can see the market actually kind of normalize to a certain point over here. So you can see maybe this excess area over here, the slope here, which accelerated the blow up. You can see it retract very quickly. So something to keep note of. We'll continue to look at the fallout from this particular trade almost 18 years ago. We'll take a look at what also occurred with some of Eifuku's other major positions. So we'll go over, Eifuku also had a very large position in Sega. And as part of the liquidation, Goldman actually shopped the Sega block not only for 1 day, but they actually shopped it for a couple of days, pushing down the price. So you could tell that Goldman started making inquiries of liquidating the Sega shares on January 8th, which was exacerbating and actually destroying any kind of margin left for Eifuku. You could see the stock go down by 20%, and finally, by the time they liquidated, they were liquidating the shares. You could tell the volume here. They were liquidating Eifuku shares between the 15th and the 23rd, and so their margin got blown up as well, as they really lost their holding power that they've on the shares that they've actually used as collateral. So quite a shame for them, but you can kind of tell that after there was a certain amount of shares up, you see a small recovery. 2003 was not necessarily a good year for Japan and Sega. Sega was fundamentally not a strong stock at the time. So we do see it continue to go down, but this is a bit of the price action that occurred in this particular stock back then. So, Goldman is well experienced at managing these kind of liquidations, as you could tell, in multiple countries. So it's no wonder that actually Goldman was able to come out relatively unscathed from this situation. Okay. The last thing, just for fun, we'll compare some of the large hedge fund or hedge fund-ish type trades and banks that have blown up over time, and really look at this Archegos capital loss in the context of history. So I think we may work a little front and back here. So Archegos Capital was rumored or said to have been about $15 billion in equity capital. And given that the prime brokers are already trying to recover their losses, the Archegos Capital likely has lost this entire equity value. To put it in perspective, about a little bit more than a quarter century ago, one of the most famous blowups was the Queen of England's bank, Barings Bank, going under and effectively being sold to ING Barings due to losses that it suffered in Nikkei futures on the Singapore on Cymex. That losses amounted to be about $1.3 billion at the time, which was considered a very big deal, enough to bring down an entire, multi-century existing bank. When we fast forward just a few years, long-term capital management ended up with probably what was total of losses of 2.3 billion. I think there was more losses to the banks at the time on the mark to market, but they had nearly all their 2.3 billion wiped out. We can fast forward to 2006 with Amaranth. They blew up on a natural gas spread trade that went horrifically wrong. Those losses were about 5.0 billion. So in 8 years, in 3 years, you could see an almost doubling. In 8 years, you could almost see a doubling of losses. Then losses, I think, were pretty much in these ranges. The JP Morgan London whale was about 5.8 billion, which was considered quite large at the time. Melvin Capital just happened so recently, with losses of estimated to be 4.5 billion. And really now to top it off is Archegos Capital at 15 billion. So we are definitely seeing a very large inflation in at least losses of hedge funds over time. So quite interesting to look at it in the context of history. Now, the thing is that I think the losses in such long-term capital management did create some real shockwaves to the market for a couple of days. Melvin Capital has definitely recreated this kind of way of Reddit investing. But I think in this case for Archegos Capital, it does seem like the fallout and its after effects are quite limited. So in that sense, in terms of a market, besides the stocks that got sold, it is a bit of a positive sign that you can absorb such losses and really not miss a beat. So quite interesting to take a look at. Okay, well, thank you for watching and listening. I hope you enjoyed the video. Please check back in and we'll go over another topic in a short period of time. Okay, thank you.